Welcome to another episode of The Future of Money. I'm your host, Henri Arslanian, and welcome to this another exciting show that we have today. My goal with this podcast is very simple, as many of you know. It's really to go deep in some of the biggest ideas, trends, and developments we're seeing in the field of crypto, and hopefully empower you with this information and then let you make your own decision on what their impact can be on the future of money and finance. And to do this, I invite each week one of the leading figures of the global crypto community to have this one-on-one conversation amongst crypto aficionados and discuss some of these topics. First of all, I just want to say a big thank you to you all for making this podcast such a success. Now the podcast is in over 160 countries. Thousands of you listen to each episode, and it's obviously distributed to my 500,000 followers every week. So really a big thank you for all the success. If you like it, please give the show a 5-star rating. It really helps with more people discovering the show as well. And also another big thank you for all the support on my latest book, The Book of Crypto, that just came out a couple of weeks ago. Really, it's became the #1 new global release in financial services. It became a top 10 global bestseller in financial services as well. So a really big thank you to not only to my publisher, Palgrave, but to all of you who really made this book such a success. I really appreciate it. I'm launching a book tour soon globally over the next couple of weeks, so you'll hear more about that as well. Before I start, I want to make a disclaimer. The Yield App is a current sponsor of some of my educational content, and many of the names we'll talk about today on the show as well have been previous sponsors of my content as well. So I just want to make the full disclosure out there with regards to Yield App for the benefit of our audience. But today we're going to talk about a very topical, topic that is really, gathering a lot of media, and I know it's a big talk within the crypto community and outside. Is really what's happening with lending platforms and the broader state of risk management and other topics relating on crypto assets. And to do this, my guest today is Lucas Kiely, the CIO of Yield App. Lucas, great to have you with us on the show.
Thanks, Henry. Good to see you again.
And also, one thing, by the way, about Lucas, you people may not know, is that he's actually a tennis dad. He's living in the south of France. So here you go. It's not only about crypto, but obviously very in tune with what's happening with tennis world, especially because of his son, who's actually a rising star. So Lucas, you must be very proud on that perspective. Again, so welcome on the show, Lucas. Before we jump in, would you share with the audience a bit about your personal journey and your personal background as well? And then we'll talk about Yield App and about platforms.
Yeah, no, absolutely. I was originally a biochemist. I did my undergraduate at Oxford as a biochemist, and it didn't really work out for me. It wasn't really something I did, so I dropped out of Oxford to go and be a software engineer at Bankers Trust. I was writing risk systems and portfolio management systems for the Bankers Trust derivatives desk. Moved to Barclays, went through LTCM as a software engineer for the prop trading desk that was quite heavily exposed to LTCM. Then I moved to lastminute.com, wrote some software for them through their IPO, and then joined UBS, I think where Henry and my paths crossed, building was head of e-commerce for their private bank, where we were building an affluent banking platform. And then I moved to exotic derivatives trading, where I spent 15 years of my career trading and managing complex risk for both UBS and Credit Suisse. Culminating in managing about $14 billion of assets across about 44 different fund strategies. From there, I set up a hedge fund, Global Macro, and then moved to Diginex as the CIO in 2019 and became CIO at Yield App in the last summer, 2021. So it's been a bit of a journey. I've been in finance for a long time and sort of enjoy the software technology side of it as well. So I've got a bit of background in both, I guess.
No, absolutely. I think especially your time in not only will you have good experience in traditional financial markets, but also in crypto as well. I think you qualify as a veteran of the industry, which is awesome. So Lucas, actually, can you maybe for the benefit of our audience, maybe share a bit more about Yield App? What is Yield App? What does it do, and what services does it offer?
So Yield App is a platform where users can come along, put in their crypto assets, be it stablecoin, Bitcoin, Ethereum, and earn a guaranteed return on those assets. There's obviously similar platforms out there. I think what differentiates us from many of these platforms is what we do behind the scenes, and we can go into the weeds on that on this show, Henry. But ultimately, where we're at is we have 80,000 clients who've trusted us with their digital assets. We've given them a guaranteed return on those assets, and what we've done behind the scenes to generate that return is probably a little bit differentiated than what others have done, and that comes from my experience in finance and managing assets over the years.
Why don't you tell us more? I mean, obviously, there's a lot of lending platforms like you mentioned, right? And how is Yield App different? I mean, how you mentioned what happens behind the scenes is what one of the elements that makes it different. Can you share that? What is that kind of differentiator?
Absolutely. I think one of the big problems that people run into is how you scale a lending platform or an earning platform, so to speak. Uh, the other thing that I think a lot of people lost sight of in digital asset space is credit risk or counterparty risk, and how you deal with managing. If you make loans to counterparties, how do you judge their credibility or credit risk? Um, so a lot of people, what they did was, and I'm speculating here because I don't work for any of those companies. I just work for us, and a lot of them use like DeFi pools to earn returns from market making and liquidity provision. Some loaned out those assets to Bitcoin miners or other infrastructure projects. Some just did straight out loans. Some did leverage, just investing. I mean, people do lots of things to generate yield, right? You can build structured products, sell volatility to earn yield. You can loan money out to earn yield. You can do arbitrage, market neutral trading strategies, provide liquidity provision to market makers, things like that. So there's lots of different ways to earn yield. And what happens, or earn a return, and what happens is, depending on your risk appetite, is the higher the yield that you can get. And I think a lot of people lost sight of, as yields get higher and higher and higher, it generally means the risk you're taking gets higher and higher and higher. So what we did was we look at DeFi in two ways, right? We find you can use it to provide liquidity provision and have some lending protocols, etc. But ultimately, it can become a liquidity trap. And as you get bigger and bigger, you find that you're more and more concentrated in the more blue chip pools, and you take on more risk as you go into sort of other pools as well. And realistically, I think you need to build, like any portfolio system, strong diversification through your platform. But as you get bigger and bigger, I think your choices become less and less.
And you raise a good point. I mean, do you believe following the Celsius event, we're going to have an increased focus on risk management on behalf of lending platforms, and that should or would it have an impact on the yields that platforms can offer? Because if there's a focus towards some of these blue chip platforms and the move away from some of the DeFi platforms and the more risky assets, we should see yields go down on some of these lending platforms purely for this reason, regardless of other market conditions as well that we can talk about.
So yeah, absolutely. And I think what we've got to look at is what is kind of the risk neutral or risk free rate in digital assets, and really it's probably Fed funds plus the borrow value. And going back to your prime brokerage days, Henry, you'll remember that there's a stock borrow, there's the same with crypto borrow, right? What is crypto borrow, and then who are you lending it to, and how is it collateralized? There's a big difference between collateralized lending and uncollateralized lending. There's a big difference between unsecured creditors and secured creditors, and where do you stand on the debt table or the seniority table when it comes to being a creditor? The thing that I think is desperately needed in this space is regulation. I think regulation will clean up a lot of the misgivings that the industry has got in this space. I mean, realistically, people are coming along to these platforms, they're loaning them their digital assets as unsecured creditors with full title transfer. And perhaps they don't quite understand what that really means. It really means that platform owns your assets. So then you want to understand, what do they do with those assets behind the scenes? And if what they're doing is just lending it out to generate a yield and not having any kind of risk management processes in place or having any true governance processes in place, then you're obviously at a much higher risk than those that have strong governance, strong processes, people that look at the real value of investments, what the quality is. And you might find that you're in a Bitcoin mining project in Texas somewhere that your capital's been loaned out to, and that's a 3-year lockup, but you've got daily liquidity on your platform. So things that, like liquidity mismatches, really, really come home to roost. And as we've seen with kind of state ETH on the Lido protocol, people are struggling because all of a sudden it's no longer a 1-for-1 peg.
Yeah. And it creates a liquidity mismatch, as you said, right? And I think a good analogy on this, Lucas, is, in 2008, when we had the Lehman collapse, right? That's a lot of hedge funds realized, whoa, actually, my prime broker is rehypothecating my assets, and they own my assets. And I think the same thing, like you said, I think a lot of people were not reading the terms and conditions of a lot of these lending platforms from that perspective, right? And I think it's going to be very interesting to see what the fallout could be. I mean, but do you believe? Let's say you mentioned the depegging of staked ETH and ETH, basically, right? Do you believe moving forward, a lot of the lending platforms will simply back away from these platforms. Or at one point, when the dust settles, again, yields will be very attractive. People will be using a lot of these, not only like DeFi protocols, but also in the case of staked ETH. I mean, it was quite interesting, quite attractive for many funds, right? I mean, do you think it's that's it? We're never going to touch them again, or eventually, you think with proper regulatory oversight and risk management, you think there's a space for appropriate risk in some of these platforms or protocols?
Let's break it out firstly, right? If we look at the DeFi side of things, as an infrastructure play, there's some incredible infrastructure and some credible platforms that have been built. So I don't think that goes away. I think the capabilities that these things brought us from financial science perspective has been amazing. Let's not forget how Spotify and these other protocols started. They all started with Napster, right? And everyone said, oh, Napster, this is that. But, I look at DeFi as Napster on steroids, right? It's just the same thing, right? The infrastructure is amazing. There's some very, very talented people who have written some very, very credible platforms. Now, people will always say to you, oh, but it's not solving a problem that needed to be solved, or et cetera. But we don't know what problems need to be solved until we get there, right? I remember when the iPad was launched, everyone was ridiculing Steve Jobs about the iPad and why no one would need an iPad. What a silly idea that was. And I'm pretty sure that majority of your listeners own more than one. So I think from an infrastructure perspective, DeFi works, right? From a pegging perspective, we look at pegs. There will always need to be pegs, right? You and I have probably lived through people trying to go after the Hong Kong dollar peg and the Singapore dollar peg, and I lived through as a young child or as a teenager going through the pound sterling peg and its exit from the financial. I was the one that Soros did the exchange rate mechanism, the RM, and people will always go after pegs. Pegs become more and more interesting the bigger they become, right? The bigger the payoff if it fails, they become much more interesting. So you take something like Terra Luna. It just got too big not to ignore, right? And it was always going to be failed math, the same way that Freddie Mac and Fannie Mae were failed math that they'd never fail, right? We can go back to Nobel Prize winning professor that said it was impossible that they would fail. I think, Joe Stiglitz. Yeah. So he said that was never going to fail. And I think there's a paper written by Harvard which is similar. It's never going to fail in a million years. And you look at the math and it's the same poor maths, right? It's the same stuff, right? So, if you've been an exotics trader or you've been through a few crises, you see the flaws in these models. And we learn from those models. We learn, we adapt, we move on. And I think DeFi will have to change. People won't be able to sort of just set up a pool, raise some money, get some liquidity, pay some bribes and get their pool up as easily as they have been able to. But I don't think it goes away.
Look, can I ask you a question, let's say on the risk management side, right? So obviously, if we look at the stablecoin ecosystem, we have the regulated stablecoins like USDC, USDP, and others. We have the unregulated US dollar stablecoins like Tether, USDT. And obviously, then we have the whole world of algorithmic, I don't know if we could call them stable coins or not, but let's say the algorithmic world of Luna, but also, frankly, the MakerDAO ecosystem would die, right? What's your view on from a risk management perspective on these stable coins? Do you think we'll have a flight towards USDC? Do you think we'll have people will still remain comfortable with USDT Tether? Or you think there's an overall rethinking of risk management, counterparty risk when it comes to stable coins?
I think stable coins will always, to me, be a credit instrument, no matter which way you look at them, because they're backed by something or a central place, right? So it's the quality of that credit that we obviously care about. Is me giving money to government? We grade that differently, depending on the government. Are they AAA, AA, A minus, etc.? I think stable coins will essentially have a certain discount rate associated with them based on the credit quality of that coin. So the better the quality of what backs it, obviously, the greater the quality of that asset. So people would say that USDC is kind of the gold standard of stable coins. And I think people have been going after Tether for as long as it's been around. And, I'm on the fence with Tether, right? Because it does provide a purpose for people. The question is it really as stable as people say it is? I mean, people obviously try and create this uncertainty around it, but generally those are the people that are trying to go after it as well. So by creating that sort of uncertainty, it kind of pushes it where it wants to go. Ultimately, I think if you look at the books of Tether over the last 2 quarters, they've been really improving their balance sheet. specifically addressing a lot of the concerns of the community. And that's really, really good to see. But there's a lot to be said for absolute transparency versus greater transparency. And I think a lot of people would like to see absolute transparency. But I think the only people that really should have absolute transparency are the regulators. And if the regulators are happy with what they've done, then, it's not necessary to say that's the gold standard, because obviously we all remember Arthur Andersen and Enron, right? It's the same, but ultimately we've got to have a place of trust that says, okay, we're okay with what they've done, right? Because if you were to look at the balance sheet of some, gold standard banks and say, hey, what have they pledged at the Fed? You'd be going, oh, that's not quality assets either, right? So it's the same thing. I think if the regulator, especially the SEC, is happy, then I think, we should get comfort from that. But don't forget, as a government issuing entity, which is the US Treasury, etc., they're probably more interested in their own stablecoin or their central bank digital asset or central bank digital currency, and have a vested interest in perhaps the failure of independent stablecoins. So it's an interesting one.
I would argue with on that one, Lucas. I think that when I look at Tether, I think they probably have committed mistakes in the past, right? From the intercompany loans, all the stuff that they have been disclosed. But I think from now, I think the proof is in the pudding, right? What's been happening the last couple of weeks, redemptions are going as they should. They've improved their balance sheet, like you mentioned, and they provided some kind of level of transparency as well. I think which gives a lot of comfort to the ecosystem. And that's what I wanted to ask you about as well, because do you think we're going to see increased levels of transparency in lending platforms? Obviously, over the last couple of months and years, we've seen stablecoins now provide increased levels of transparency. Do you think we will reach a point where lending platforms are going to provide some transparency on where they're lending their assets and where their assets are for the benefit of their users? Or do you believe there's a risk that because of this transparency, some other crypto hedge funds may actually take their positions and try to kind of, a bit do what George Soros did to the British pound you just discussed earlier, 20, 30 years ago?
I have a kind of a more sort of simple view, which is I think transparency in finance is a good thing. I think trust is the bedrock of the financial system. And the more transparent you are, the more trust you're going to have. But that doesn't mean there's not going to be bad actors that go after your positions. And the question, though, is as a manager of capital or a manager of client money on these platforms is, what is it your ultimate goal, right? Is your ultimate goal is to borrow money as cheaply as possible and get yourself as rich as possible? Well, that's that model. Is there, you're trying to work towards, let's say, a 2% gross margin on managed assets like a private bank does, or et cetera? That's another model. And the question really is you've got to find yourself somewhere on that spectrum of very low risk, repeatable returns versus very high risk, swing for the fence. At Yield App, we obviously sit on the former. We consider ourselves a digital wealth manager, and we really focus on quality investments with a lot of governance and due diligence around those. I know other platforms, if they don't have the scale that we had, their overheads are quite high, et cetera, and they might be taking more risk. I don't know. I'm not privy to any of that information. But what I do know is that with the blockchain, with blockchains in general, people can get a lot more transparency through that and see where positions are, which is where I think Celsius's trouble started, because people could see the positions they had. It's a similar position with what's going on with 3 Arrows Capital. People can see the positions they had, people that are associated with them, et cetera. And it creates this kind of contagion risk, et cetera. But I also would argue that crypto Twitter is quite a mean place to be as well, because there seems to be quite a lot of people that take a lot of pleasure in causing that instability in the markets, et cetera. And we've had rules in those in financial markets for years that, you couldn't sit there and talk up a book or, make false statements in Bloomberg chats and things like that. And you'd go to jail for that. And in crypto, it's still a bit lawless like that. And I think where regulators probably should focus a lot more on is people manipulating markets for their own ends and causing that fear and uncertainty. Because if you want crypto to be a mainstream investment or become a mainstream asset class, it will need the same regulatory controls around what people can say, do, et cetera. And I'm always saddened when I see like financial markets veterans come in and they just say, Jesus, there's just lawlessness around, people can just make stuff up and cause huge ramifications through the market. And next thing you know, there's no repercussions for them, but people's savings are gone, people's livelihoods are blown up, et cetera. So that is a bit of a problem for me.
Nah, it's going to be very interesting. I think you're right. That's where I think we need a bit more. I totally agree with you. We need regulatory frameworks to kind of prohibit this kind of behavior, and that's going to be beneficial for the broader crypto ecosystem as well. I have a couple of questions, Luca. I want to ask you, wearing your CIO hat, right? Obviously, at the time of recording this, the markets are in a downturn. A Bitcoin is just under $20,000. ETH is around 1,000, 1,100. I mean, I wanted to ask you. For many years, many in the crypto ecosystem had this perception that Bitcoin was a hedge against inflation, especially in the era of quantitative easing, where central banks are printing money around the world. Do you think that theory still holds true, that Bitcoin, similar to gold, could be potentially a hedge against inflation? Or do you think it's more akin to risk on assets like tech stocks, for example?
You could argue that tech stocks are a hedge against inflation as well, right? I believe that real assets are a hedge against inflation. And what you consider real assets are is down to you. What I would say is inflation is something that you hedge against, but once it's arrived, if you're not hedged, you're kind of done. So if you were sitting there thinking, I'm going to own, digital assets because I believe the Fed's printing incredible amounts of money, its balance sheet's getting larger and larger, it's causing huge inflation pressure. We have a shock, and then we're going to have huge inflation find its way into the system, which is where we are now. If you've held crypto assets or digital assets in that time period, then you could argue that has been a hedge against inflation because, if I go back to, 2020, even the end of 2020 where we were, still half of where we are now in Bitcoin, right? But it's still also a speculative asset, the same way that gold can be a speculative asset or oil can be a speculative asset. The question is are you now buying digital assets because it's a hedge against inflation? Well, the inflation is here. So you've either had it and you've hedged that inflation, or you're now using these as speculative assets to go and, recover that inflation loss. I mean, it's a very different mindset. So for me, I think, all real assets, houses, commodities, etc., they are a hedge against inflation until that inflation arrives. And then you really need to be liquid, right? If you're liquid, then you can deploy to some really promising investments, because in crisis is where the opportunities really present themselves.
And actually, you mentioned the crisis, right? Do you believe the current situation for many, let's say, traditional hedge funds, many of the people that we know in the traditional industry, for example, do you think they're going to look at the current situation as a potential opportunity to come in and actually enter the space at valuations that are lower than what they were literally only a couple months ago? Or do you think this is going to still give them a lot of cold feet and actually they're going to hold back and they're not going to jump into the industry from that perspective? So do you think the current markets provide an opportunity for traditional investors to come in, or it's kind of still a lot of red flags for them and they'll be careful before jumping in?
I mean, I think there's some really big traditional investors already in this space. They've probably obfuscated their involvement. Likes of Goldman Sachs, JP Morgan, etc., are obviously heavily invested in this industry, in this space. And we see that, HSBC, UBS, they've all got sort of digital asset businesses or digital asset forums in which they're working out what they're going to do. I think the biggest concern most investment houses or investment banks have is the AML KYC piece of the history of coins and the history of crypto. It does have a checkered past. It doesn't mean it's all clean, but so does, I think, all finance generally you could say has a checkered past. I think what people are starting to realize is there is lots of opportunity. There's lots of great technology. There's lots of incredibly talented people who have transitioned into digital assets from traditional markets. I mean, if you take market neutral strategies, right? If you were running, gas oil versus heating oil arbitrage, I mean, you probably can run that BTC versus ETH the same way. And I know people that do that and do very well from that. Basis arbitrage exists, derivatives or volatility arbitrage exists, structured products exist. When you either have massive inflation like we have now or near zero interest rates, which is also kind of what we have now, people are still going to be chasing yields. And yields generally come from either selling volatility or running arbitrage strategies or high frequency trading, market making strategies. And we also have correlation, although you could argue that correlation is one or near one in digital assets. I think that will change as different coins get adopted. So I think the real issue is not if, but when the extra people come in. I mean, there's two sides of crypto, right? Or digital assets. There's the visible side that everyone sees as a kind of, it's a bit basic, a bit retail in some ways, and that's not meant as a pejorative. It's just you see this side, and it's what gets all the headlines. But behind the scenes, you have incredibly talented teams building amazing projects, doing great infrastructure, doing great evolution of finance. And I think being a part of that is fun. And it's also really interesting to see how we've applied, our correlation models, our option models, et cetera, to what is essentially quite a gappy product or underlying. And when you start to trade gap risk, markets become really interesting. How do you monetize the gamma in your options when the market's just gap and then there's nothing, right? People talk about a very volatile asset class, but it moves very, very quickly and then it just does nothing. And it's very hard to monetize those sort of things. So I think that the evolution is happening every day, and more institutions are adopting what we're doing.
And Lucas, you mentioned market neutral funds, right? Obviously, there's a lot of funds that there's a lot of opportunities in basis trading and relative value and other strategies you just mentioned. You've been a portfolio manager, you've been a CIO for many years. Do you really believe, based on what you just mentioned, do you believe it's really possible to run a long-short crypto portfolio or an absolute return crypto portfolio, just considering the state of not only the crypto markets, but the state of the evolution cycle where we are in crypto markets today?
I do. And I think actually it's where the real opportunity set is if you're not trying to be greedy, right? If I was just trying to earn income on my assets, and we do this a lot at Yield App as well, as we look for strategies that are highly liquid, easily repeatable, with good pedigree managers to run them. We have a large position in what we call triangulation arbitrage, where because we take stablecoins, Ethereum, and Bitcoin, we can run dollar BTC, dollar ETH, and BTC ETH cross arbitrage. We run basis is actually really hard at the moment when it's very difficult to earn in basis, but it's sometimes very difficult to earn basis in futures versus cash in equities and things like that. So these things are cyclical. I think the most important thing with a market neutral strategy is to have more than one option, because otherwise you're kind of forced to trade, and being forced to trade is a recipe for disaster. So I think if you're running, integrated ARB or integration ARB, triangulation ARB, basis ARB, I think venue ARB is becoming increasingly difficult, especially there's a very, very little credit in the crypto ecosystem. That cross-collateralization becomes quite hard. There's a few prime brokers that do it and are very, very good at it, to be fair. But there's a lot of things that you can do in sort of the arbitrage strategies as well as market making, high frequency trading, that will generate you around 1% to 2% a month consistently, and have done still through these markets. And I think, we use a lot of them. They've done phenomenally well. Last month was a great month for us. This month's performing also pretty well. For me, it's a better choice than being locked up in a DeFi pool, if that's my honest. But that doesn't mean you should have diversification through your portfolio.
Absolutely. I think this is going to be, like you mentioned, I think for a lot of these market neutral funds, this is actually where we're going to find out if a fund is a real market neutral fund, or actually had them directional exposure as well, based on the performance of literally, May and June 2022 from that perspective. I just want to ask you as well on a more macro level, right? So, Lucas, like from your perspective, obviously you have a lot of experience in traditional markets. What do you think we need to see in the industry to go from where it is now to the next level? You mentioned regulations. Do you think regulations are what's needed, or you think we need more volume, we need more liquidity, we need more institutional players, we need more traditional players to enter? What do you think the one or two key elements do you think are essential for the industry to go from where it is now to 2.0?
So I'm a big fan of regulation, probably a bit of an outlier when it comes to it, because I've worked in structured products and complex derivatives for most of my career, and regulation is there to protect those clients or to protect those investors. And it's done great things for financial innovation, because it also levels the playing field, right? You can't just go out there and say, hey, have this, have that. And we've all seen the capital guaranteed products and et cetera, shark fins and accumulators, decumulators, and what happened to those during the GFC. But ultimately, what I think regulation does is it provides peace of mind to your clients. It gives them an avenue to go to when things go wrong, and things will always go wrong with someone or somewhere. I think also what we need to work out is there's a lot of people in the industry who I kind of liken to getting on the Mayflower to leave their past behind, right? They wouldn't pass a fit and proper test in a traditional financial regulatory environment, and they shouldn't be managing money. If we want to see digital assets as real money, then there are certain people that just shouldn't be managing other people's money. And because there's no criteria or there's no sort of obligation to sort of show and tell about who's doing what behind the scenes, I think it creates this kind of uncertainty. But I think you should have to pass a fit and proper test as a manager to be able to manage a client money. I mean, it's the one thing that is all about trust. And I think where we sometimes lose track of that is that someone has an amazing return, the returns are amazing. We go back to Bernie Madoff and what those guys were doing there. And I remember doing the DD or working with the guys that were doing the DD on that for UBS. And it was just like, we just could never understand it. And we do the same when we look at managers today. It's like, I just can't understand it. But there's tons of managers we look at and they sit there in the background. And, you've got liens over your assets from the IRS. You've got, fraud claims from the SEC, stuff like that. Do the work. Don't give them your money, right? And that's where the regulators need to come in, I think.
So I think there's I totally agree with you on this. Look, I think we need more regulatory presence. I mean, it's incredible that there's the fact there's so many crypto hedge funds operating without any kind of oversight. And if it's not regulators, I think there's a duty on investors to do operational due diligence, to ask these questions, to even run these background checks, to do this fit and properness tests, because otherwise, you just need one bad apple that contaminates the rest of the industry, right? So I think that's one of the big risks we need to avoid from that perspective. Lucas, we really are out of time. I'm getting, my producer is actually messaging me saying that we got to stop. But I want to ask you one last question before we move to the final round. Is what's your view on crypto current markets? Obviously, we're in a bear market right now. Do you think this is going to go on for some time? What's your overall view on markets right now on crypto?
Well, so I think crypto is correlated to risk assets at the moment, and all risk assets are off. So just sitting there going, crypto's off, Nvidia's off, tech is off, everything's off. I think you always need a shakeout. And I think we're starting to see some stability still to step into the market, which is obviously a good thing. The next few weeks will be critical. But I'm bullish, innovation. I'm always bullish innovation, and crypto is about innovation. And so the same way I like some certain semiconductor stocks and tech stocks, I like crypto. I think it's a good industry to be in. The innovation is amazing. A lot of the people are amazing too. And I think it's a great place to be. That's where I think, and it will hold up over time.
Here we go. So Lucas, we're going to finish it off with the 5-round set of questions. And my bell is with me. So I'm going to ask you quick questions and I need 1 or 2 word quick answers. And we're going to take it from that perspective. Are you ready?
I'm always ready, Henry.
I love that answer. Here we go. Lucas, what is the thing that shocked you the most when you entered the crypto space? What is the one thing that shocked you the most when you entered the crypto space?
Fraudsters, the number of fraudsters.
Yeah, unfortunately. Okay, what traditional hedge fund manager would you love to hire as an intern at Yield App?
Oh, I like the guys at Nine Masts very well. Some of the guys at Millennium are pretty good too. So there's some great guys out there, but yeah.
Love it. What crypto CEO impresses you the most? What crypto CEO impresses you the most from all the crypto CEOs right now in the market?
Sam Blankman-Friend,
yeah,
for sure.
Yeah, from FTX. Same thing on the traditional side. What traditional financial institution impresses you the most right now with regards to their crypto initiatives?
Goldman Sachs.
And what is that, by the way, out of curiosity?
Just what they're doing in their options space is pretty phenomenal.
Yeah, absolutely agree with you as well. What advice would you have to anyone wanting to start in crypto? What is the one piece of advice to anyone who wants to start in crypto?
Check your ego at the door.
Man, I wish we could record this and actually frame it in front of anybody. Everybody wants to enter the space. I love it. If you could give one advice to any university student today, what is the one course you recommend they take that you think will be very helpful for the rest of their career?
I think sort of the financial mathematics classes like arbitrage theory, etc. I think are really important.
Absolutely. More personal side, Lucas, what do you do on your weekend when you're not busy managing a portfolio? What's the one thing you love to do on weekends when you're not busy working on crypto?
I'm an Uber driver for my son. Currently only have a 4-star rating. But yeah, I'm just traveling all over the place, taking him to tennis tournaments.
Talking about tennis, who's your favorite tennis player, or you think the best tennis player of all times?
Oh, that's a tough one, Henry, because I've always liked Andre Agassi. I've got to say he's been my favorite. He's been an entertainer and someone that made me love tennis as a child. And don't think that, the elegance of Federer, the passion of Nadal or the teutonicness of Djokovic will ever surpass Agassi's flair.
I totally agree. As I grew up loving tennis because of him as well, and somebody with Armenian background always related to him as well. So, and again, last question, Lucas, to finish it off. Again, Lucas Kiely, the CIO of Yield App. Lucas, if you can have dinner or lunch with one person, dead or alive, lunch or dinner with one person, dead or alive, who would you have lunch or dinner with?
I think Che Guevara, actually. I think he's kind of like been sort of touted as this amazing, revolutionary, but I think he was just a bit misguided. So I'd like to just ask him some questions. What do you think?
I love it. I love the answer. Well, Lucas, it was great to have you on board. Where can people find you? Where can people find if they want to learn more about you, get in touch with you? What's the best way to find you on social or other ways?
I'm on Twitter, so you can find me there, but I don't really speak much. We have a Telegram groups at Yield App, etc. I try to just keep behind the scenes and not be involved in a lot of the day-to-day sort of the crypto runnings, because I think as a wealth manager, I think you're better off just staying silent and keeping yourself to yourself, and let your returns do the talking, and just be available if people want to talk to you. If you can go through our team at Yield App, and they can organize calls with me, but I try to just be behind the scenes and just look after people's money more than anything else.
Wise words as well that I think many would benefit from as well. So look, it's great to have you with us. Again, thanks for everybody who listened to the show as well. Again, put a 5-star rating if you really enjoyed it. It will help more people discover the show. Again, if you want to stay on top of the latest developments on crypto and the future of money, make sure to also follow me on LinkedIn and Twitter, especially for my weekly Crypto Capsule show, where I summarize the global crypto developments you need to know in less than 60 seconds. And also, of course, as I mentioned before, my latest book, The Book of Crypto. Thank you for all the support. But if you're looking for a summer gift or a summer reading gift to somebody who you want to enter the space, the Book of Crypto is there for that. So, guys, thank you very much, everybody, for joining us. Thank you very much, Lucas, for being with us today. We're going to let you go back and be the Uber driver dad for your son to his tennis practices. And thank you, everybody, and see you all soon for another episode of the Future of Money podcast. See you all soon, and see you all next time.